Hello, everybody. My name is Michael Duke, and welcome to my show where I analyze stocks that are interesting. So, if you find that interesting, then please consider liking this video and subscribing to the channel so you see more. Um, I have been very, very hard at work the last few weeks trying to scrub the floorboards to find interesting companies that make sense in this environment. Frankly, I have a lot to share with you. But today I want to talk about an interesting one called FirstCash Holdings Inc., ticker FCFS. This company is actually headquartered in Fort Worth, Texas, a few blocks from where my wife and I used to live when we lived in Texas. Very, very fascinating. This whole saga started a few weeks back. Obviously, the markets have been very volatile the last few months, given tariffs, a lot of recession talk. We had the negative GDP print a few days ago. We've had all of this data come in about the economy, tariffs and trade, lots of bad data, lots of good data, tech earnings, Microsoft, Facebook, all that. So there's been a lot of volatility to stomach along the way. But this all got started because I really wanted to take a look at equities that I think would outperform in the current environment. And by the current environment, I mean one with lots of uncertainty, with um, evidence of some modest capital flight out of the United States. We have deflationary pressure on the one hand with tariffs, but we have inflationary pressure on the other with tariffs. Commodity prices being all over the board, consumer confidence at the lowest level in years, and lots of fear in the marketplace. So I wanted to think what businesses do well in a recession. I'm not saying that we will be in a recession or that we are going to be in a recession because I can't tell the future. However, I wanted to find out and explore the idea, are there businesses that boom during a recession? And that's how I got to taking a look at this company. What this company does is they are a pawn store operator, throughout the United States, Mexico, and the rest of Latin America. Why would a low value retailer like a pawn store operator be a good recession stock? Well, I think it goes without saying that pawn shops are they're essentially a lender, a consumer finance oriented lender at the low end of the credit spectrum. And in theory, when people are either hoarding cash or want cash because they lost their job, or they're just fearful about the way things might be, or they have a bunch of gold that they're trying to monetize so they can buy other things because they already have money, you name it. Pawn shops, in theory, tend to do well in a bad economy. So that's the thesis here. But then I took a look. Then I found out this company again. I recognized the logo. It's on an office building close to where I used to live. I was like, oh yeah, I know that company. I took a look at their website, took a look at their numbers, and actually was very interested by what I saw. So, as usual, in today's video, given that this is a new company that I have not taken a look at before on the channel, I'm going to give an overview of the business. I'm going to discuss their business model. We're going to take a look at the financials. We're going to discuss some of the risks. We're going to take a look at the valuation, the dividend, do some technical analysis, and I will give it ultimately my review. Before we dive into that, as always, this does not constitute financial advice, and it is purely my opinion. So let's get into it. Let's take a look. So, on their website, they claim that they are the leading international operator of pawn stores. FirstCash focuses on serving cash and credit constrained consumers. Cash and credit constrained consumers primarily through its retail pawn locations, which buy and sell a wide variety of jewelry, electronics, tools, appliances, sporting goods, musical instruments, and other merchandise, and make small non-recourse pawn loans secured by pledged personal property. Not a bad business, actually. While the consumers or third parties that are pulling these types of loans are at the lower end of the credit spectrum. In fact, that's what the company acknowledges here. It's actually not too bad of a lending business because they have the item in their possession and can easily take it if you default on the loan. Try our layaway service for that special item. With our convenient layaway plan, you can buy what you want with an affordable 10% down. You never know what you'll find on our shelves. We buy and sell just about every. Okay. This right here is interesting. We buy gold. Most people have gold, silver, or platinum that can be sold for immediate cash needs. That's right. Precious metals are a large enough item category here that they specifically call that out on their website. Most items in our stores are eligible for our convenient layaway program throughout the year. Simply inform one of our friendly associates you're interested in putting an item on layaway and we'll start the process for you. Cancellation and service fees may vary by state and are non-refundable. You want to buy a fancy watch, maybe a wedding ring, engagement ring, you name it. And then they also talk about the convenient interest-free layaway plans. Here, pawn loans. So this is kind of the meat and bones of it here. Pawns are a great way to borrow money fast on items you already own. Loans are based on the value of the item you bring in, not your credit or when you get paid. We can loan you money on just about anything: jewelry, TVs, cameras, tools, DVDs, CDs, musical instruments, and more. To get your pawn, you only need two things: a valid ID and the item. Okay, you get the idea. And then here, bring us your items and they will assess their value. I'm sure most of my viewers have probably watched an episode of Pawn Stars before. This is the business we're in here. We will buy most items damaged, broken, unwanted, or unused: jewelry, necklaces, chains, pins and brooches, rings, earrings, watches, and watch bands. Hopefully it's pretty clear why this might be a good recession stock. Okay. I'm just going to kind of jump around here best that I can. I did decide to enlarge my likeness here for the sake of the production here, but let's just minimize that somewhat. So on April 24th, they released their first quarter results, and needless to say, they look pretty good. So I'm just going to skim through this on behalf of us here. FirstCash reports record first quarter operating results. Earnings per share increase 39% in total, 34% on an adjusted basis. Operating cash flows fund store additions or expansion, and $60 million of first quarter share repurchases and continued quarterly cash dividend. Okay, 38 cents a share. The ex-dividend date is May 15th, if I remember correctly. Resulting first quarter net income grew 36% on a GAAP basis and 32% on an adjusted basis. So these are comments of Mr. Rick Wessel, the CEO, saying demand for pawn loans was robust during the quarter in both the U.S. and Latin America, with ending same-store pawn receivables increasing 13% in the U.S. and 14% in Latin America, and that's on a local currency basis versus last year. This marked 7 consecutive quarters of double-digit same-store receivable growth in the United States segment, which drove a 17% increase in earnings from the company's largest operating segment. So that's pretty impressive. When I looked at these numbers the first time, I was frankly blown away. by how robust they look. Driven by a 19% increase in the number of merchant locations and further diversification outside of the furniture vertical, AFF delivered strong results as well. I believe AF point of sale. AFF is some sort of point of sale segment, retail POS payment solution. So they have a point of sale segment. AFF delivered strong results as well, with earnings growth benefiting from solid credit performance and significant cost reductions, excluding certain furniture retailers that closed last year due to bankruptcies. Number of active doors increased 29%, which should drive future revenue growth with greater merchant vertical diversification. So, in addition to the retail footprint, they have a point of sale solution that they are placing in other retailers. That's interesting because conceivably it's fairly asset light. Strong cash flows for the first quarter provided funding for the addition of 12 pawn locations, further purchases of store real estate, $60 million of stock repurchases in addition to the ongoing quarterly cash dividend. These investments are expected to deliver further earnings accretion in 2025 and beyond. So let's just take a look at these numbers here. These are for the quarter. The quarter ending March 31st in the prior year and this year. Revenue is about the same on both a GAAP and non-GAAP basis, but you see the huge difference here in net income. So conceivably a strong amount of operating leverage, resulting in, that's close to 50%. I think they said 39%. Really strong earnings per share growth on a GAAP basis and 30 something odd percent on an adjusted basis. And you see here the share buybacks occurring. Okay. Moving on, 12 pawn locations were added in the first quarter through an acquisition and new store openings in 3 countries. The U.S., a high-profile luxury buy-sell retail store, was acquired in Las Vegas, Nevada. 1 new location in Texas was opened during the first quarter, with 10 new store openings in Latin America in the first quarter, which included 9 locations in Mexico and 1 in El Salvador. The company purchased the underlying real estate of 7 U.S. stores during the quarter, bringing the total number of company-owned locations to 407 versus, they said, 3,023 locations. So almost 15% are they own the underlying real estate. While owning the underlying real estate is not necessarily a good driver of return on equity, because typically owning your own real estate really lowers your returns on equity. We see other retailers like Costco typically own a majority of their real estate, and that is really more of a long-term play. So I don't really know what to think about that, but it certainly is interesting. And then they say here the POS segment, which they describe as merchant partnerships. There are approximately 14,500 active retail and e-commerce merchant partner locations, representing a 19% increase in the number of active locations. Excluding furniture locations, due to bankruptcy, the number of active doors increased 29%. Very interesting. During the first quarter, the company repurchased 525,000 shares, common stock, at a total cost of $60 million and an average price of $113 per share. You see here the current share price is in the 130s there. So already that has paid dividends, so to speak. Over the past 12 months, the company has repurchased 1.25 million shares of common stock at a total cost of $145 million, paid out $67 million of cash dividends, representing a payout ratio of approximately 75% of net income over the same period. And they still have $55 million available under the current buyback program authorized in July 23. The company generated a 14% return on equity, 6% return on assets, and adjusted at 16% and 7%, respectively. 2025 outlook. This is relevant. We've looked at a lot of outlooks the last few weeks, and most of them were either maintained or slashed, particularly the video we watched yesterday on Matson, which gave pretty bearish guidance on the year moving forward for obvious reasons. So again, they state, driven by the strong first quarter results and continued demand for pawn loans, draw whichever conclusion from that you may. Continued demand for pawn loans is a bit of a dubious economic signal, I will say, but I digress, given that that is the main investment thesis here. The outlook for 2025 remains highly positive, with expected year-over-year growth in income driven by the continued growth in earning asset balances. Earning asset balances, I would imagine, just means the amount of collateral that they have driving pawn loan income. Anticipated conditions and trends for the remainder of 2025 include the following. Pawn operations are expected to remain the primary earnings driver in 2025. The company expects segment income to be over 80% of the consolidated income. The company expects further growth in the U.S. in the pawn store base in 2025 through the combination of new store openings and potential acquisitions. The guidance provided below does not assume any material acquisition activity. Same-store pawn loans in the quarter were up 13%. April balances to date up similarly. Given the strength of first quarter same-store results, the increase in pawn fee growth is estimated to be in the range of 9 to 11%. Retail sales are expected to grow mid-single digits. Margins 41 to 42%. Very strong margins for retail. Again, if we want to think about a retailer, Costco is really the one that I'm knowledgeable about, but very typical in retail to see low single-digit margins, whereas our pawn store margins 41 to 42%. Insane. U.S. dollar reported results for Latin America are expected to be impacted by the lower exchange rate for the Mexican peso, which has most recently been in a range of 20 to 21 pesos per dollar, compared to the average exchange rate of 18.3 to 1. Now, I will say that our Mexican peso exchange rate, Mexican peso has appreciated meaningfully in the last few months. So you see here, they were basically taking a look at this chart here where our Mexican pesos had depreciated quite a bit, and they're saying, yeah, not great. But if we look at the year to date, we see the Mexican peso, even since the 31st, this is the 31st of March here, we see that the Mexican peso is actually up almost 5%. Since they were saying that Mexican peso is like 19 to 1 right now. So already we have favorable currency tailwinds in terms of the Mexican peso. This is a theme that I've discussed ad nauseum the last several weeks. You see this borne out in the results of stocks like Philip Morris International that have a majority of their sales in non-dollar currencies, having significant year-to-date performance. We're already outperforming our projections here. And I won't go off on a tangent too much here, but I think it is pretty simple to understand that Mexico is a beneficiary of the trade war between the United States and China. In fact, Mexico might be the main beneficiary of the trade war. And if if tensions are to further deteriorate, I see Mexico being a big winner there. So while this investment thesis does not hinge on the strength of the Mexican peso versus the dollar, it is notable to discuss that the Latin America pawn segment might outperform given currency tailwinds. Same-store pawn receivables were down 5% on a dollar basis, but up 14% on a constant currency basis. So again, they're looking at this kind of weak peso environment, this peso sliding environment here. We see that kind of bottoming out and trending back up. Full year pawn fee growth now expected to increase into 10 to 12% on a local currency basis. So we know with a stronger Mexican peso, we're going to augment those numbers by several percentage points, most likely. Despite an 8% year-over-year decrease in first quarter originations, the forecast for full-year origination volume for 2025 is expected to be consistent or slightly above 2024 volume, excluding 2024 originations from, this is in POS. We know American Freight went bankrupt. Excluding originations from, origination volumes are expected to increase in a range 20 to 25%. Each full point change in the exchange rate of the Mexican peso is projected to have an annual earnings impact of approximately 10 cents a share. So again, when they gave these when these results came out, it was here. However, they were basically saying they expected it in the 20 to 21 range. So based on that math, we've already accreted 10 cents a share over the last 3 weeks or so. Not a huge impact, but that's almost, on a earnings per share of what was it, $1.87, 10 cents a share is close to 5%. So that's pretty good. I like Mexico as an investment product here, and believe that while that's not really the theme of what we're discussing here, that it is fairly significant. Let's just take, as I tend to do, let's take a step and look back over the last 10 years. So we see here that revenues have come up from 700 million to 3.1 billion, 4.5 times. But we see that gross profit, 391 million to 2 billion. That's about 5 times increase. So, as is the hallmark with all of the best companies that we take a look at on the channel, we notice a pattern that gross profits are increasing faster than revenues. So they check that box. Also, just the sheer amount of growth that we're seeing over time is substantial there. That's a very, very strong compound annual growth rate. We see about that 4.5% times increase in operating income. So the operating leverage is not as significant there because that roughly is increasing in line with revenues. So really, the gross profit margins going up over time, very, very strong. And then earnings from continued operations from 60 million to 281 million. That is also roughly a 4.5 time increase. So we see here basic earnings per share increasing from 216 to 627. Well, that's only about a 3 times increase, not even a 3 times increase. So shares must have gone up over the period. We do see that they've actually issued shares over time, 28 million shares to close to 45 million. So that's not ideal. The fact that they are buying shares down now is a positive that we want to see. They clearly, the fact that they're issuing shares is somewhat commensurate with this pretty insane growth. It's conceivable to think that they've issued shares to complete acquisitions somewhere in this period. And then we see here the dividend per share from 57 cents to $1.49. That's almost 3 times. Very strong growth with a fairly low payout ratio. In fact, payout ratios come down over the last few years. So they've been tilting more of that capital return towards buybacks. And we see EBITDA here increasing almost 5 times. Very, very strong results over time. Very encouraging to see their gross profit expansion performing the way it is. 146 million of cash and 335 million, of inventory, and then we have some AR there, 571 million. With a few other items there coming to 1.3 billion of current assets, and then we see here net property, plant, and equipment over $1 billion there. So there's the real estate right? There's the real estate that we are acquiring. We see here gross property has increased pretty significantly from 220 million to 1.5 billion. But yeah, 1.5 billion of real estate. One thing that kind of sticks out is is the amount of goodwill we have on the balance sheet here. I don't like to see that, but not too surprising when we think about the amount of acquisitions that they've done. That essentially means that they've paid pretty strong prices for the acquisitions that they've made. Is that good? Is that bad? Well, I think it comes down to, are their returns on equity strong? Are their returns on equity strong? Maybe we'll chart that here in a moment. But we see here total current liabilities of 301 million versus our 1.3 billion of current assets. Their current ratio is very good. In fact, just on cash alone versus current liabilities, very very liquid looking there. 1.7 billion of long-term debt. What we're seeing here is they have continued to issue debt, lots of debt, 1.7 billion. So um, they have 1.3 billion of current assets versus their 1.7 billion of long-term debt. That to me just looks like a company that is aggressively plowing things into growth. However, we see here the fact that retained earnings continue to go up, with the exception of 2015 to 2016, that they're not issuing that debt to pay dividends, which is, I think ultimately what I want to see when I see the debt ballooning like that. I don't like when companies pay dividends with debt. Don't like that. And that's not what we see here. So the balance sheet looks fine. They have plenty of current liquidity, plenty of current assets, but they're certainly not flush with cash, and they certainly like to use debt. So I think the income statement looks phenomenal. The balance sheet is, I wouldn't give it an A plus, but not bad. No red flags, at least in this simplified view that we're looking at here. Let's take a look at the valuation. Seeking Alpha gives this a D minus grade. Um, I think what's important here to take a look at is the price book ratio, 3 times. That's pretty aggressive. Price to sales, we have that on a B plus grade. So uh, I think we probably need to take these relative grades with a grain of salt. The sector median numbers are worse in most categories than our sector median numbers, and that's because we're versus financials, not retail. However, what I do notice here is that our all of our earnings multiples are lower than the 5-year average. And our PEG ratio being less than 1 is pretty freaking good. Um, However, our price sales ratio is about average. Our dividend yield hovering just over 1%, excuse me. Speaking of the dividend yield, we don't have a forward-looking free cash flow yield in here. That might be something we want to investigate a little bit further, but on a trailing 12, 8% free cash flow and 7% operating earnings, 7.5% on a forward, 8% backward looking. Um, those are pretty good yields. Again, I don't love retail stocks. I love Costco stock. This stock has a substantially higher yield, really in every conceivable way. But if we look at the dividend yield, we're pretty much in line with average. However, we are a little on the low end compared to what we've really been since we saw a full year of payouts. We've been hovering really in a range between 1 and 2%, and we're on the low end of that range. So I think when we're looking at the valuation, again, this is a pretty quick and dirty analysis of the valuation. I think what we're looking at here in the valuation is that it looks okay. It doesn't look super tantalizing. I wouldn't call it a D minus. I'd call it a solid C, just middle of the road. It looks to be a fair price. I think in terms of a yield, we've got really good yields. It's worth investigating why we're not seeing a forward free cash flow yield. Are they plowing a bunch of free cash flow into capex acquisitions or buying real estate and the like? We should probably investigate that. But I think all in all, we've got pretty decent looking valuation, although it's definitely not it's not screaming value. One thing I want to discuss here is the performance. We see here over the last year, it has outperformed the S&P 500 by 3 points. But one thing I want to note is really the seeming inverse correlation here to the index, which I really like. You see here when the S&P 500 is going up in this period and when it's going down, this stock is doing the inverse in terms of a trend, but we have similar spikes here on a day-to-day basis. Here, there's more of a positive correlation. Here, while we have the S&P going up, FirstCash is going down, and then here it kind of flips. And then here, again, February 18th, 19th, that was really when the current downtrend in the stock market started. This stock has been going up. So I really like what that looks like. Again, the whole thesis here is we're looking for a stock that's going to outperform the market in a bad stock market. And I think the performance over the last year, at least visually scanning, I did create a tool that allows me to analyze this using data. However, it's experiencing a data feed issue right now, so I'm not able to use it for this. Unfortunately, I'm still working through the kinks there. But just visually analyzing this, it looks exceptional and exactly what I want to see. And then we see over the last 3 years, we've massively outperformed the market 2-1. Over the last 5 years, we've pretty much market performed, but underperformed the majority of the time. Over the last 10 years, we've slightly outperformed the market, and we've crushed the market over the last 30 years. In fact, this IPO'd in 1999. Very strong performance there. Let's take a look at the return on equity. A bit volatile over time. We see kind of a steady uptrend. We peaked at 25% and really saw a steep drop off, but we've been trending up. I would prefer to invest in things that have a double-digit return on equity. The fact that we're somewhat volatile over time is not ideal, but where we're sitting now is pretty good. So gross profit margin has, we talked about it expanding, and it has expanded somewhat, but the degree of expansion has been up and down. That's not too surprising to see for a retailer. However, I think the drastic increase in gross profit faster than revenue, when we drill down to the numbers like this, we saw that was driven a lot by strong gross profit expansion here. Okay. Let's take a look at a few other things. Retained earnings here. So what's interesting here, we see this spike where retained earnings came down, equity came down. So there must have been some sort of acquisition event that occurred there. In fact, if we look at our share count, let's look at long term. We see here that is where our share count increased and our debt load increased. Our debt load increased substantially. So it would be worth understanding if we look at the September 2016, the company merged with Cash America International Inc. In December 2021, the company acquired American First Finance. Cash America International and FirstCash Financial Services completed a merger of equals, producing a new company. And then they entered the buy now, pay later payments industry with the acquisition of American First Finance. The deal was announced here. So you see that they have, at the time of both of those mergers, they have ballooned their share count and their debt count to perform these acquisitions. And that is what drove a decrease in the return on equity. So here, what we saw here was more of the pure play return on equity. But what we do see, what I see here from this point, since the buy now, pay later acquisition, while we continue to issue long-term debt, we've pulled down our share count, and our return on equity has increased, and our gross margins have increased over that period. And you see this acceleration in retained earnings. That explains our numbers, what we're seeing there. I think that explains it fairly candidly. I'm going to keep that graph open because I'm going to use it in my article that I write on. So what we looked at in the chart, I think, is part of what makes this very compelling. The fact that we have significantly outperformed the market. We see here that this stock has been a huge winner year to date, up 30% versus the S&P. And furthermore, since Liberation Day, the company increased by 5%, sold off like all stocks did, and resumed. So the company has outperformed since Liberation Day, outperformed in the months prior to that, outperformed on Liberation Day, the holy grail and holy trifecta of recession stock greatness that I want to ascertain at this moment in time. So when we look at that, I think that that's very encouraging. But is it overheated from a technical perspective? I'm just going to attempt to do some technical analysis. Okay, so what we see here, right now the stock is pretty much at an all-time high, which I could zoom out. The stock, it broke out above its all-time high. The breakout is on. It's in a long-term uptrend and has been for quite some time. This right here is really the uptrend resistance, and really since the 2022 broader market, bear market, we've kind of seen our accelerating channel form a new wedge. This is the long-term uptrend down line here, but the fact that we've broken out to a new all-time high, very bullish actually. This here being our long-term trend line, I think we have some work to do. If we get out above that, the game is on. But the fact that we continue to be in this very bullish uptrend here, we've broken out above the all-time high, is also bullish in and of itself. So I think from a technical perspective, this is a pretty good entry point. However, if we were to fail to break above this, then we're basically the first level to fall to is where we're at right now. The next level to fall to is this line here, which might represent a mid-120s, maybe mid-110s. And then if we were to fall down below that, for some reason, we end up all the way down here. However, given the momentum in the financial results, I do find that scenario to be somewhat unlikely, given the strong positive momentum in the underlying financials, the strong story, the narrative driving the stock price. I think technically what I'm looking at is a very, very good looking chart. We're at a very key level here where we've just broken out. We've eked out over the all-time high. We've retraced a little bit back to that. We're right there hovering at a potential new source of support. So I will be frank with you. I did purchase a very, very small starter position in the stock because I like what I see. I like everything I'm looking at. And I think it's a good asset in the current environment. But it is definitely, again, any stock that's at its all-time high, of course, is going to potentially come with some volatility. But more times than not, when that's accompanied by strong financial results, that volatility is more often than not to the upside. So I think technically speaking, the chart looks phenomenal, and we are at a good level here. The breakout has occurred, and now it's on to the next leg. But we do have this next level to overcome, and we're very, very close to that. In fact, a few dollars a share away from retesting at that level again. So we'll see what happens. So what about the risks? Well, I think the risks here are you have integration. They continue to purchase. We see how they're using a lot of debt. We see how they're using their issuing shares. This isn't going to be one of those like steady as she goes stocks that is going to plod along and not surprise you with their acquisition activities. So I think there's modest level of integration risk. That clearly, the acquisitions have paid off, as we've seen in this chart here, where they've shown very adept ability to integrate the platforms that they have acquired in each of these scenarios. So the acquisition activity is a risk. I think another risk here is that we flip from this environment of kind of dubious macroeconomic backdrop into a more stable growth environment, in which case I wouldn't necessarily think that this business, the underlying business, wouldn't continue to succeed. I think that there might be less enthusiasm around the stock price. So I would say that that is a risk. But fairly benign right now, given my belief about the way that things are going to be, at least for the next year, if not longer than that. I think another risk here is the currency risk. Again, I think we have a very favorable backdrop for the Mexican peso, but a majority of the earnings are in dollars. So even though, well, while the stock is denominated in dollars, if the Mexican peso were to significantly weaken, that would create a headwind on earnings. However, I think again that risk works in our favor here in the immediate term and uh, conceivably for the long term. Um, so currency risk is one that they say every point or every unit of movement in the Mexican peso versus the dollar represents 10 cents a share, which at the current level is more than 5%. Um, or I guess that would be, yeah, more than 5%. So yeah, that's pretty meaningful. Um, but when you have earnings per share growing at 20, 30%, 5% one way or the other isn't going to break the bank. So yeah, those are the risk factors. You have the fact that we're on a growth spree, we're on an acquisition spree. Those always have the risk of harming shareholder value, but I think management has shown themselves adept at that over the last few big acquisitions. They've definitely shown ballsiness to be able to make large acquisitions, but that they definitely are, utilizing every tool on the balance sheet to be able to do that. So when, if and when we make that next acquisition here, it is worth monitoring how the balance sheet is affected by that. We have the sentiment risk of things getting better in the underlying economy, which paradoxically will lead to probably some less enthusiasm for the shares, and then the currency risk. However, I do believe that there's enough evidence of each of those things working in our favor, either historically or in the go forward, for the risks to be on our side for this one. So, despite the fact that the shares have ran a lot as of late, I still really like the shares here. So, that's going to conclude my thoughts on First Cash Holdings Inc. For all my viewers out there, thank you for watching this. Hopefully, you found this useful, interesting, and instructive for your own portfolios. As always, this is not financial advice. If you are contemplating an investment in the company, please do your own research and don't just outsource all of your analysis to me. Although, hopefully, what I'm doing here in analyzing the numbers is beneficial to you in being able to know where to start and where to go when analyzing. So, thank you so much for watching. It's been a good couple months on the channel here, and had a lot of fun and uncovered a lot of gems, I think. And this one, I'm pretty optimistic about this company. It's very interesting. Of course, I have an affinity for the fact that it's headquartered in Fort Worth, very close to where I used to live. That is a bonus in my book. Um, but thank you for watching. It's always a pleasure to deliver this content to you. Hopefully, you found this interesting and I will move on to the next piece of content. I've got a lot to work through and a lot to share with you that I've been working on. So I will get to that, but in the meantime, thank you for watching and have a good rest of your day. All right, until next time, see you later.